Are you here to improve your investment strategies? Are you looking for that one article that could help you finalize that decision you were holding off? Well then, get ready to learn more and gain just that subtle extra knowledge to get an edge in the investment business. Because if you're new here, then you've come to the right place. Welcome to The Daily Fortune, a channel where we talk about all the latest news, updates, guides, and strategies related to investment. Of course, with that said, we're going to be discussing a lot about the Oracle of Omaha, Warren Buffett, The Big Short, Michael Burry, the money tree Cathie Woods, Tesla's very own CEO and eccentric billionaire Elon Musk, along with the rest of the big leagues to learn just a bit more from the professionals. And don't worry, of course we talk about crypto, and we also talk about the best stocks to invest in, along with many tips and tricks on how to handle your finances so you never lose. So before we talk about making money, remember to hit that like button, subscribe, and ring that notification bell as well to make sure you won't miss a single video. Now let's get started. Some people are asking if there will be a coming recession. Well, we don't know for sure, but the Bureau of Economic Analysis, or BEA, might answer that biggest question. The BEA has a website where all of this information is publicly displayed. But most people never go there and pay any attention to it. And here's how it works. The gross domestic product, GDP, is simply a measure of the market value of everything a country produces each year and determines whether or not we're in a recession. There are 4 quarters in a year since it is calculated in blocks of 3 months. Since these estimations are provided to us 3 times, each of which is somewhat more accurate. Since measuring the GDP is extremely difficult, they must provide us with multiple estimates. The first one, known as the advanced estimate, is the one the market pays the most attention to because it's the one they spend the most time gathering all that data for. This data is generally released 4 weeks after the first quarter has ended. Thus, for the first quarter of this year, which ran from January to March, it was released on April 28th, exactly 4 weeks later. When the GDP data for the advanced estimate was released, it stated that the GDP was negative 1.4%. This alarmed investors, who then began selling off their stocks, cryptocurrency, and real estate out of fear of the impending recession. A recession occurs when we get 2 consecutively negative GDP reports. These numbers indicate a recession. They only need to be negative for 2 consecutive quarters. For this reason, they must provide us with many estimations to ensure that the data is as precise as possible. But also because information is released in bits and pieces as businesses declare their revenues, pay taxes, and other things. Due to this, on May 26, which has already passed, we got our second estimate for that first quarter. In the new document, they stated, never mind, we're not down 1.4%. Actually, it's a little worse than we thought. We're down 1.5%, and that scared investors even more, so they sold off more. On June 29th, we will receive the third estimate of the first quarter's gross domestic product. Now, the document might inform us that the GDP is even worse, meaning the market will decline even further. It might also say that it will remain stable or even improve. However, the likelihood is that it will remain negative. We won't know whether we're in a recession or not on June 29th, but this is the precise date when we will find out. The BEA will announce its second quarter advance estimate at 8 a.m. on July 28th, just like a judgment day. Let's hope that we don't receive a negative GDP, because if we do, that will signal a recession, which the media will start covering after the first quarter was negative and the second quarter is negative. In this video, we'll dive into some new information that should help explain where we are right now and where we might be headed in the future. The Nobel laureate economist Robert Shiller just said this week that he believes there is a strong probability that we are going into a recession. A Nobel laureate is someone whose study has had such a significant impact on society that they're given a certificate, a medal, and $1 million as a reward. Robert Shiller won the prize in 2013 for his empirical examination of asset prices and is now calling for a recession. This man clearly knows what he's talking about. Fortunately, there is a tool called the Atlanta Federal Reserve's GDP Now tracker that calculates what our current gross domestic product may be. It's not an official measure of GDP, but it makes a precise estimation of our potential rate rate of economic growth using the same methodology. So you can see how close they are by comparing the initial estimate from the Bureau of Economic Analysis with the GDP Now tracker. So in terms of accuracy, it's fairly accurate, but what they're predicting right now doesn't look good. On May 27, their GDP prediction read 1.9%. Well, it's good because it's not negative. However, notice how quickly these percentages are changing. On June 1, they updated their estimate to 1.3%, meaning we lost 0.6 in just a week. And now the numbers are looking much worse. On June 8, they revised the estimate down even lower to 0.9%. The good news is that the GDP prediction is not negative, which indicates there won't be a recession, but the bad news is that their margin of error is 0.85%, meaning that the real conclusion of whether or not a recession will occur may depend on a rounding error. Additionally, it will still be around a few weeks before we learn the truth on July 28th. But for the time being, the estimations are getting progressively worse. The interesting part is that every time we discuss inflation and observe rising food, gas, automobile, and housing prices, it goes to confirm the idea that a recession is impending. But in reality, inflation and a recession is not the same thing. Therefore, sometimes when we believe something is true, we can make it happen. This is bad since consumer spending accounts for around 70% of the GDP, which is a big deal because whatever you believe will happen will influence how you spend your cash. In addition, recession-related searches are increasing according to Google Trends data. So at this moment, it may be a self-fulfilling prophecy, because the first thing you likely want to do if you think there's a chance of a recession is cut back on spending. So it will decrease the GDP, which is certainly bad. And that's the first issue. The second issue this week is that the World Bank has warned that a recession similar to one that occurred in the 1970s might be coming. Let me describe what that was like and show the significant risk of what the odds might actually be for us who were not there in the 1970s. So what are the World Bank's functions and its motivations for warning us that a recession is coming? Few people are aware that the World Bank was originally founded to promote world peace. It's a network of 189 institutions that collaborate to support nations that have suffered because of international conflict. One of their objectives is to help combat poverty and provide funding for developing nations so they can rebuild their infrastructure. The World Bank was established during the so-called Bretton Woods Conference in 1944, which was followed on December 27, 1945 by something else you might already know, the IMF, or the International Monetary Fund. But the World Bank was established because it was believed that the way nations treated Germany following the First World War, forcing it to pay all of the losses and making it feel unfairly treated, was a contributing factor in the Second Global Conflict, and the World Bank was established to stop that from happening again. The World Bank indicated this week that the increase would be closer to 2.9% than they had previously predicted. They had previously stated that the world grew by roughly 5.7% last year and that they had anticipated a 4.1% growth this year at the start of the new year. Now, they predicted that developed economies like the one in the US may rise by an average of 2.6% in 2022 and 2.2% by 2023. The reason they're giving us these reduced projections is that the situation in Ukraine is slowing down investment and trade activity, and because the economy is open, the pent-up demand from people staying at home has already been satisfied. Moreover, the tools of the monetary and fiscal policy are not accommodating. These are the tools of the government and the central bank for their goal to reduce inflation, which comes at the expense of raising the danger of a recession. When we hear statements like this, it doesn't inspire investor confidence, which is why the market fluctuates one day and then drops the next, but also why it's mainly selling off. In fact, the World Bank president just said, for many countries, a recession will be hard to avoid. This is definitely not a good indication. However, the fact that the World Bank is also warning people that we could suffer stagflation similar to that of the 1970s is what has investors the most concerned at the moment. Stagflation is entirely different. And what does it mean? When real wage growth is negative, there is a rise in unemployment, there is inflation, the cost of goods are rising, the GDP is declining, or the country is producing less. This is known as stagflation, and it occurred in the 1970s, so the World Bank is now warning us that there is a chance that it may happen again. And they outlined three key explanations for why the world today resembles that of the 1970s. First, because of coronavirus in some parts of the world, we continue to see supply-side disruptions that contribute to inflation. Second, ever since we lowered interest rates to zero, people took advantage of the cheap money and spent it, which boosted the GDP. However, now that interest rates have increased, the economy and GDP are swimming swimming against the current. Therefore, it stands to reason that people would like to borrow less and spend less, which would result in a decrease in the gross domestic product. And third is that our Papa Paul is committed to raising interest rates at all costs in order to reduce inflation, which makes complete sense. But that's not helpful because it also comes at a time when it's hurting developing nations. And that's because we created it so they require our money to transact business. Therefore, when we hurt, the entire world hurts as well. We're kind of faced with the same decisions today as we were in the 1970s, which is a cruel twist that's coming back. Does raising interest rates to combat inflation harm the economy? Or do we enable inflation to persist but harm employment? That's a decision we have to make, and neither option is good. However, in the 1970s, they found a solution when their Papa Paul Volcker raised interest rates to 14% in an effort to combat inflation. But even so, this caused a recession, which was then followed by an increase in interest rates to almost 20%, which also hurt their economy. Stagflation now enters the picture because, as we all know, when inflation soars and prices rise across the board, wages rise too. For this reason, wage growth peaked in the 1970s at about 8% in the late 1970s and early 1980s. While that may sound terrific, it results in a real salary rise of -6% when compared to the inflation rate of 14%. Therefore, it's essentially the same as saying that it serves no use to give employees a dollar raise if the price of food, petrol, and everything else increases by $2. That's what you call stagflation. Now, to a certain extent, that is already occurring, but there is good news. Unlike in the 1970s, the dollar currency is quite strong, which is wonderful for us consumers because it means we have purchasing power with respect to international commodities we import. The goods we buy would be much more expensive and would increase inflation if the dollar were weaker than it was in the 1970s. Furthermore, commodity prices fluctuate much less now than they did in the 1970s. But most importantly, having lived through the 1970s, we're now more knowledgeable and wiser, and we already know what to avoid, such as price controls like we did in the 1970s, and government subsidies that cause businesses to raise their prices because if they know that the government will pay for something, what does it matter if they're going to raise their prices? And that will basically result in inflation and avoid an export ban which results in even worse inflation. In other words, we have a manual that guides us not to repeat the mistakes of the past. Currently, we don't know for sure what might happen. No one is certain. The key date to truly remember and put on your calendar is July 28th. That's the time we'll know for sure whether or not we are in a recession. However, if the GDP turns out to be positive, it's a good thing because it means we can reset the counter to zero. At that moment, the earliest that a recession could start would be at the end of this year or the start of the following one, since as you may recall, a recession lasts for 2 quarters of 6 months. And there you have it. You can comment your thoughts in the comment section below. Thank you for watching. So that's it for today. I hope you learned something from today's video, and to get updated with the next videos, don't forget to hit the notification bell. See you next time.